Hello students, welcome to AKS. Today we will deal with the economy current affairs for the third week of August. So first let us look into the newspaper article which raises concerns with respect to the 2015 government's notification on emission standards for coal-based thermal power plants. Let us look into the details of this issue. The Ministry of Environment, Forest and Climate Change has notified the revised standards for coal based thermal power plants in the country in the year 2015. These standards are proposed to be implemented in a phased manner. Thermal power plants are categorized into three categories, namely the ones which are installed before 31st of December 2003, and next the ones which are installed after 2003 up to 31st December 2016, and next those thermal power plants which are installed after 31st December 2016. The new standards are aimed at reducing emission of PM10, particulate matter 10, sulfur dioxide, and oxide of nitrogen, depending upon the age and capacity of power plants. Apart from that, power plants are also required to enhance water use efficiency. The new norms were required to be adopted by the year 2017. However, it has now been extended to the year 2022. So let us look into the implementation part of these norms. So implementing these new emission norms require retrofitting existing thermal power plants with advanced technologies so as to control sulfur dioxide, nitrous oxide, PM emissions such as flue gas desulfurization, FGD, which we call as, and selective catalytic reduction, SCR, and the electrostatic precipitation systems. So what are the benefits of these? This enables to bring about an improvement in the ambient air quality in and around the thermal power plants. The next important benefit is that the technology employed for the control of sulfur dioxide and nitrogen oxide will also help in the control of mercury emission. Limiting the use of water in the thermal power plant will lead to water conservation as thermal power plant is water intensive industry. Thus, a reduction in energy requirement for the drawing of water is also one of the benefit of implementing these norms. Next, the Reserve Bank of India takes offbeat tack to help reverse growth slowdown. So, what is the context? The RBI opted to break with the convention by reducing the key policy rate, that is the repo rate, by 35 basis point BPS to 5.4% as it focused monetary policy measures on helping revive demand so as to tackle the deepening economic slowdown. This is the first time that RBI has moved the interest rates by a figure that is not a multiple of 25 bps. This was done because, on one hand, the cut of 25 bps was considered to be inadequate, while a cut of 50 bps was considered to be much higher. The RBI has also slashed the real GDP growth for 2019-20 from 7% to 6.9%. So let us look into the new policy rates. The repo rate is now 5.4%. The reverse repo rate is about 5.515%, which is usually maintained 0.25% below the repo rate. Also, the MSF, the marginal standing facility, is 5.65%, which is indifferent to the usually maintained 0.25% above the repo rate. So, what are the details? The RBI revised the growth forecast to 6.9% for the financial year 2020 from the 7% which it earlier predicted during the June policy, while the first quarter of 2020 to 21 the growth rate is expected to be 7.4%. Also, the consumer price index based inflation is projected slightly higher at 3.5 to 3.7% for the second half of the current financial year and 3.6% for the first half of the next fiscal. With the rate cut, RBI has now reduced the repo rate by 110 basis points in 2019. Apart from the rate cut, RBI has reduced the risk weightage for the consumer loans, except credit cards, from 125% to 100%, a step to address falling consumer demand in segments such as individual vehicle loans and personal loans. So, some other important decisions taken by the RBI include the payment system. The 24 by 7 NEFT transfer, that is the National Electronics Fund Transfer Payment System, operated by the RBI as a retail payment system, will be made available on a 24 by 7 basis from the December 2019. This is expected to revolutionize the retail payment system of the country. The bill payment system expanded. In order to leverage the advantages of the Bharat Bill Payment System (BBPS), the RBI has decided to permit all categories of billers except prepaid rechargers who provide for recurring bill payments to participate in the BBPS on a voluntary basis. Currently, it covers five segments, that is DTH, electricity, gas, telecom, and water bills. Digital Fraud Registry. The RBI has proposed to facilitate the creation of a central payment fraud registry that will track digital transaction frauds. Next, let us look into the issues in the Insolvency and Bankruptcy Code. What is the context? Recently, the government has extended the final deadline for resolution of insolvency and bankruptcy cases from the current 270 days to 330 days. Another 60 days has been given so that courts can settle last minute litigation. Since the new 330-day deadline is not binding on the courts, the new deadline may not be viable. As of 2015, the insolvency resolution in India took about 4.3 years on an average against 1 year in the United Kingdom and 1.5 years in the United States of America. Sooner the money comes back into the banking system, the sooner it can be deployed into the economy. Thus, to expedite the recovery of loans, the Insolvency and Bankruptcy Code was enacted. However, it is still plagued with several issues. So, what is the impact of the Insolvency and Bankruptcy Code? IBC is a vast improvement on the two earlier laws legislated to recover bad loans. That is, the earlier laws such as the SICA, that is the Sikh Industrial Companies Protection Special Provisions Act of 1985, and the Recovery of Debts Due to Banks and Financial Institutions Act RDDB Act of 1993. Before the IBC, resolution processes took an average of 4 to 6 years. However, after the enactment of IBC, they came down to 317 days. Also, the recoveries are higher after the IBC, that is 43% after the IBC, as against only 22% before the IBC. However, out of the 12 big default cases referred to the National Company Law Tribunal (NCLT) in the year 2017 by the RBI, not even half have been resolved yet. So these are some of the fundamental issues even after the implementation of IBC. Also, many big cases involving thousands of crores, including the SR Steel and Bhushan Power, have been exceeding the 270-day resolution limit by a mile, crossing 2 years. This has forced the government to set a new 330-day limit, which will include time taken in addressing legal challenges. The IBC leads to value destruction of profitable businesses. Creditors are likely to prefer selling of the firm's assets to cut their losses rather than evaluate the risk of letting the company run its operations. Also, the assets of such a firm are more valuable if kept together as a functioning unit. So now let us look into what are the reasons for the delay in IBC resolution process. Number one, it is the slow judicial process in India which allows the resolution processes to drag on. This was the same reason for the slow recovery under the Sikh Industrial Companies Act and the RBBD. Also, the next important reason is lack of capacity. There are inadequate benches to hear and resolve disputes quickly at the National Company Law Tribunal. Third, these factors lead to the erosion of public money. For example, if inflation is 4%, every year's delay effectively reduces the recovery by the same proportion. Also, the time value of delays in the SR case, assuming an inflation rate of 4% and where the final bid is worth over 42,000 crores, is close to at least rupees 5 crore every day. So, what is the way forward to this issue? The government may ask the Supreme Court to frame rules so as to ensure that the National Company Law Tribunal judges are accountable for the delays and to set up a system to evaluate the efficiency of judges in the bankruptcy courts. Also, non judicial commercial experts in the National Company Law Tribunal should be increased and more NCLT benches to be created. The Insolvency and Bankruptcy Code law must differentiate between financially distressed firms and the economically distressed firms. So, here one of the solution is that the IBC law must differentiate particularly between the financially distressed firms and the economically distressed firms. Okay, so that is about the IBC, the significance of IBC, the improvements the IBC could get into the loan recovery process, as well as the various issues and way forward for the insolvency and bankruptcy code. Thank you. Have a good day.